Hi, everyone. I'm Caitlin Moore, the Financial Literacy Manager here at UBT. And tonight we're going to be talking about other forms of payment. So different ways that you can get pay and payday loans and how they work and why they are not good. So we're going to start with other forms of payment. So to start off with, there are several types of payment that you can utilize, whether you're getting paid or want to pay someone. And I've listed out several that we're going to talk about. So EBT cards, cashier checks, wire transfers, checks, debit, credit cards, cash, prepaid cards, gift cards, and electronic bill pay. And then there's obviously really nice ways of paying online. So PayPal, Apple Pay, Venmo, Zelle, cryptocurrency. I don't even have all of them listed, but we're just going to go through a couple of those and kind of talk through some pros and cons of them. Because what I have learned from being in this job at UBT is a lot of people are being paid at their job in ways that is not traceable or trackable, and it's not good. So if anything, I'd really like to empower you to learn a couple ways to get paid so that you can make that decision for yourself and what will work better for you. So here we go. We're just going to go through each of these and what they are. So EBT cards, short for electronic benefits transfer. EBT cards operate like a debit card. So you can swipe them at the register, and they're for SNAP. So your SNAP benefits, Supplemental Nutritional Assistant Program. So they put the amount on this card. It's almost like a prepaid card every month, and you can swipe it at the register. It does account for what you're buying as far as if you are eligible to buy certain things, but you get the amount that is given that you qualify for, and you can swipe that at the register. Cashier's checks, they are bank checks. So the bank is writing a check on your behalf. You pay the bank in cash what you want the check to be, and they write out a check for you. So a lot of people use cashier's checks to pay their rent. So they go to the bank with, let's say, $1,000 for rent, and the bank will write a check to the landlord and you give the money. The thing with the cashier's check is once that check is written, that piece of paper is worth that amount of money because you've already paid for it. You've given the bank your, say, $1,000. So you don't want to lose that check, but it's as good as cash. So a benefit of a cashier's check is, say you're paying your rent, you go pay the bank, they write you that check, you hand it off to your landlord. You don't have to wait for that to come out of your bank account. It's done. So that's the benefit of it. There's a lot of places that require cashier's check for various reasons. I'm thinking when I bought my house and I had to pay the down payment and fees, I had to get a cashier's check. They do that to alleviate the risk on their end. So if I wrote them a check to buy my house, and let's say they deposit that check and I don't have the money in there, they would have to come after me for that money. So with a cashier's check, it's done, it's over with, the amount is there, and it's already been paid. A wire transfer is an electronic transfer of funds between bank accounts. So I could call UBT and say, I want to transfer $150 over to so-and-so, and they will do that for me. It's an electronic transfer. So just like when you go to the store and you use your debit card, it's transferring the money out of your account into someone else's account. A lot of people use wire transfers for large sums of money. So businesses will use wire transfers to transfer from one business to another. You can do it at most banks. You just have to call them and you might have to pay a fee for that. Moving on, checks. A check, which we don't see very often. I don't even have a checkbook. A check is a written form of cash to pay for goods and services. So if you write a check, it's as good as cash. So you could go to Target, write a check for your goods, and they're going to cash that check, which means they're going to put it in their bank account, and that money is going to get taken out of your bank account into theirs. The risk of a check is that if you write a check today and it doesn't clear, meaning let's say Target doesn't deposit your check into their account for a couple of days and you spend the money in your account, that check is going to bounce, which means there's not enough money in your account to cover it. You could be charged fees, which are, I believe at UBT, it's over $30 for a bounced check. Target, for our example, would be charged a fee and then may come after you for that also. So checks are a little bit riskier because they take a little more time to clear out of your account. So you want to be really careful when writing checks. A lot of places require checks. I'm thinking rent, places like that, because it is traceable. You can write a check and then do a stop payment where you call your bank and say, I paid with this check and I don't want that person to have that money anymore. It's a small fee, but they can stop that check from actually being cleared in your account. So it is a lot more traceable. Some people write checks for that reason, so they could track it, make sure something was actually paid. But it's a little bit more riskier, and not many people use that anymore. Debit cards are really what we're used to. That's the payment card that deducts money directly out of your account. So whatever you have in your account is what is accessible by a debit card. If you do not have enough money in your account, you could overdraft, which means you're basically borrowing money against your account and you're going to be charged a fee. There's bank accounts out there. UBT offers this that keeps you from spending if you don't have the money in there. So it will actually decline your card. It's more of a protection on your end where you're not being charged fees if you overdraft. Some people will swipe their debit card and they don't have enough money in there. It will still allow the transaction or the purchase, but you just got to get the money in there before midnight. So some people will get paid at midnight and they'll spend some money right before they get paid and it all equals out. I would not suggest this. Debit cards are in real time. They're taking money out of your account right when you spend it. So only spend what you have and put overdraft protection on your account. So some overdraft protection will just decline your card. Some of it will actually automatically take from, say, your savings account. It'll charge a small fee to do that. But let's say I went to Target today and I swiped and I don't have enough money in my account. It'll charge me $5 or $10 to go into my savings and pull the correct amount out of there and move it to my checking. It's kind of an automatic thing where I don't have to do it. The great thing about that is that it's covered. I'm only charged $5 or $10 versus an overdraft fee, which may be more than $30. Credit cards are much like a loan. That's what we want to think of when we think credit card. It's a loan. You are spending money on loan, and then you have to pay it back. If you don't pay it back by the end of the month, you're charged an interest rate to go with that. So the benefit of that is a lot of people will use credit cards to pay all their bills and everything, and then just pay it off at the end of the month. They have the budget for it and they just pay it off because they want the credit card benefit. They want points that they're getting, cash back that the card might offer, things like that. The downfall to a credit card is it's a loan. So sometimes we think, oh, we have this free money, and then we spend that, but we don't have enough to pay it back. And that's when we get into debt. The greatest way to use a credit card is to spend it and pay it off by the end of the month. If you have too much spending power on your credit card, you can call the company and ask for that to be lowered. So I always like to tell people, don't have a spending limit that you can't pay back in cash. So if you only have $500 in savings, your credit card should only have $500 spending limit. That way you could pay it off. You don't want to pay interest. There's a saying with our wealth department that says rich people don't pay other people interest. That's how they maintain their wealth. So they utilize credit cards, but they don't get charged the interest because they're paying it off at the end of the month. So credit cards are a tricky thing. Don't use them if you don't have the cash to pay it off. Another form of payment is cash. We all know this, money in the forms of bills like $20 bills or coins. I'm not going to go into that one. We all know what cash is. Prepaid credit cards, that is what it sounds like. There's credit cards out there that are prepaid or secured. So we've talked about secured credit cards where you have to basically put the cash down as a security deposit. So if you want a $500 spending limit on your credit card, you give the bank $500. You pay off that card every month until you're done with it. And then you could go back to the bank and close it. As long as you don't owe any money, you're going to get all of your $500 back. There are prepaid cards you could buy at most big box stores, grocery stores, where they're Visa or MasterCards, and you pay about a $5 transaction fee, but you could put as much money on that as you want. And it's almost like a gift card, but it works as a credit card because it has a Visa or MasterCard logo on it. So, secured credit cards are a really great way to build your credit because there's no risk involved, and banks will give that to most customers, even if you don't have good credit. So, because there is that down payment or that security deposit with it. The next one kind of have gone through. Gift cards are another form of payment. Visa, MasterCard ones, or gift cards to stores. That is a form of a payment. I have seen people put budget money that they're budgeting for certain places on gift cards so that that's what they're limited to. That seems like a lot of work, but if that controls spending, then it's a great idea. But gift cards are a great way to give people money without having to give cash. And then electronic bill payments. This is through your online bank account. Oftentimes they will allow bill payment on there, which means you put in the information for what your bill is. And then the bank writes a check on your behalf and sends it or wire transfers it to the company you're paying. So let's say your utilities. You're paying that every month. You just set that up through bill pay. You can go in there and say, I'm going to pay LES this much, and they write a check or transfer it, and it comes right out of your account. It's a great way if you're not doing online bill pay through the company to set that up on your bank account, because then you don't have to fill in all the information. You just have to type in what you want to spend, and they'll take care of the rest for you. Okay, to keep going, we've got our online payment types. So PayPal, Venmo, Cash App, all those electronic applications. What they are is they connect to your checking account or a credit card, and you can pay someone through that app. So I have a house cleaner that comes once a month, and she came today and she told me how much it cost. So I just Venmoed her money. So it took the money straight out of my checking account and sent it to her app. Now she can pay somebody else with that app with that money I've sent her, or she can transfer it back to her checking account. So it's really nice. I love Venmo. I'm a big fan of it. I don't use it for any other reason but to pay people I know. I know that some people use Venmo to pay for almost anything they possibly can, and you're welcome to do that if it's possible. Venmo and those cash apps even have a way to invest money through their websites, which is quite interesting to me. But it takes it out in real time. They'll say it takes about 1 to 3 days, and sometimes it does. But if you don't have the money in your checking account, then do not use a online cash app because it's going to take the money out. So just plan on it taking it out right away. So don't spend any money that you don't have. Apple Pay is a digital form. You never have a card. It's essentially what Venmo and PayPal do, but it's all digital. You never have a card with you. I have an Apple phone. So if you do have an iPhone, it's really nice because you could just hold the phone up to one of the debit machines and it electronically just transfers the money with just a push of a button and maybe some verification. I love it. I don't use it that often because I have an Apple credit card that I don't like to use. So I don't like to use my credit card. But if I did, I could just wave it over that machine at the store and it will take that payment out for me. And then cryptocurrency, this is a less popular way of paying. Usually big items will take cryptocurrency, but it is a form of almost like stock, but you can use it in real time. So Bitcoin is the example of this. I'm not going to go into what cryptocurrency is, but really it's like buying into the stock market that you can pay other people with. You could also buy stock in cryptocurrency like Bitcoin or Ethereum or something like that. So that's for another day to talk about that. Okay. So one of the reasons why I wanted to go through this is, and it's not on this, but I've been finding out in the 2 years I've been doing this job that there are a lot of local jobs that pay their employees through debit cards. So they issue them a debit card and they say, this is where your paycheck is going to go. Some people like this idea. They have this debit card, they can swipe it wherever, it's still used just like your own debit card, but the money never goes into your bank account. And that is fine if you're okay with what they don't offer. It's very, very difficult when you get paid through a debit card to ever see your pay stub or to account for how much you were paid. So they don't necessarily have these online applications that you can go to check how much you've been paid. So let's say you have a job at Burger King. I know they do this. They offer this as an option. You worked 20 hours that week. They pay you. but you don't have any clue how much they paid you. You're hoping they paid you your correct wage, but what if they tracked it wrong and they only have you down for 15 hours? There's no way for you to know, and you're just kind of spending until your card is declined. And that's not good budgeting. Not knowing how much is in your account is not a good idea. So I want to empower you. If you ever take a job that they say they have to pay you on a debit card, just know that they do not have to. You can tell them you want another form of payment, like direct deposit that goes straight into your checking account, or maybe you just want a paper check. They cannot tell you no. You're not required to take the debit card payment. And I would really encourage you not to, because there's no way to account for that money. When you're working, you want to make sure that you are tracking your own hours. And then when you get paid, look at your paid stub. Did they pay you the correct wage? And did they pay you for the correct hours? If you don't have proof of that, you can't go back and fight them on it and get what they owe you. So I would not take the form of a debit card payment as your payment for your job. You can ask for something different. And I would encourage direct deposit or a cash check that you can go deposit into your account. Any questions on that as I change this presentation over to the next one? Okay, get back here, share screen. Payday loans. Alrighty. If this doesn't actually show up as a PowerPoint, somebody let me know, but we'll keep going here. Oh, we have a question. Nope. No, we don't. Alrighty. So let's keep going here. Let's talk about payday loans. Okay. Payday loans this was one of the first presentations I put together because I was so invested in this idea. People should not be using payday loans. And I did a lot of research on it. I watched a lot of YouTube videos on people who had payday loans and the nightmare they went through. So we're going to talk about what payday loans are. So payday loans are short-term loans that these companies are giving you with the promise of payment. So you go in there and you say, I need to borrow money, and you can get that right on the spot, usually up to a certain amount. But in order to get that money, you have to write a personal check. So you take your checkbook in there and you say, I need $500 now, but I don't get paid until next week. And so you could write them a check for $500. They give you cash, and they're going to cash that check next week when you say that you get paid. The problem with this is that there is the chance that maybe you don't have the money in there. And then, or they go to cash the check, or they don't cash the check and you have to go make payments and you don't do it. Or you're being charged the finance charge. This is where they really get you. If you don't pay it off in full right away, usually within 2 weeks, they're going to charge you interest rate for this. And it is a huge amount. It is such a big amount that most people can't make a payment to even just cover the interest rate. So if you borrowed $500, they might be charging you $50 every 2 weeks or $150 every 2 weeks, and you can't keep up with the payments. This is how people get in trouble. Interesting fact, there's 23,000 payday lenders in the US, twice as many as McDonald's locations. So you might see the payday vendors on some street corners here in Lincoln. Most of them are up on O Street or north of O Street. I think I have a map on here for Lincoln if we keep going. So how they work is if cash is needed immediately, payday lenders can loan up to a certain amount. Each lender sets their amount. A credit check isn't required. Okay, so anyone could walk in and get money. You must have a bank account and be able to write a check. So they do require that you have a bank account and can write a check because they're going to try to cash that check. Interest is charged for various terms. They might charge you interest weekly, every 2 weeks. So those are common options. So usually what I have heard in my research says that they're going to loan you that initial amount for 2 weeks. And then they would like it paid in full before you get interest charged to you. So a lot of people will go in and pay the minimum payment, which is usually less than the interest charge. So it varies, but on average, you can expect to be charged every week or every 2 weeks, $15 to $20 in interest for every 100 you borrow. So if you borrowed $500 and they're charging you $20 every 2 weeks, in a month, they will have charged you $200 in interest for your $500 borrowed. So now you owe $700. Actually, it would be more than that. Your initial $5, and then first 2 weeks, they charge you $20 for every 100. So that's another 100. So now you owe $600. For the next 2 weeks, it's $20 for every 100. So it is $120 that they're charging you. So now you owe $720, and it just keeps going up from there. So you could see if you're not paying these off in time, the interest rate is so high. It's so high. Lenders will confirm that you have a bank account. So they're going to check into that when you come in. You will need to sign the check for the loan amount, and you will need to return to the lender the amount in the time that you agreed. So they're not going to cash your check right away. They're going to you need to come in and make a payment, whether it's the whole amount or a minimum. If they don't receive a payment, they're going to try to cash your check. So that's what that's for. So that can be really scary for a lot of people. Most people who are using payday loans are living paycheck to paycheck, which is why it's there. Accidents happen. Totally get that. And maybe there's an emergency and you need to dip into next week's paycheck. And so you go to a payday lender, but you still need next week's paycheck for regular things, especially if you're living paycheck to paycheck. All that money is accounted for. It's going somewhere. And if you borrow against it and have to pay that back, you're not going to have money for the next thing or to even pay your minimum payment. So most of the time, people who need the money don't have the money to pay it back. And that's where people get in trouble, because we're being charged $15 to $20 for every 100 that you're borrowing. So the amount just keeps accruing and accruing, and it gets higher and higher. So I did some math for this. For specifically Nebraska. So interest charges vary per state. Each state has a limit of what payday lenders can charge up to, and they can choose how high they go up to that certain amount. So in Nebraska, here's how it breaks down. Let's say you have a maximum loan amount of $500 and the maximum term. That means this is the longest they'll go out is 34 days. Okay. That's when you're supposed to pay it all. The finance charge for that $500 every 14 days is $17.65 per $100. So that's 17.65% per $100. If you did the math, the APR for a 14-day loan, APR meaning your annual percentage rate. So if you looked at this from the whole year, if they're going to charge you interest for a whole year, would be 459% of $500. That's 459% more than that initial $500, which is a huge amount of money. Huge. So let's look at this again. Let's take a look how these high interest rates are calculated. So we borrow $500. There's a finance charge of 20% for every $100. That's $20 for every $100 borrowed. So if we divide that by 365 days in a year, that's 73. 20% divided by 365. 73 divided by 14-day term is approximately 5.214. So multiply 5.214 by 100 and get an interest rate of 521%. So I know this really confuses me, to be honest, but what it is saying that if there's a 20% finance charge for every $100 you're borrowing for a 14-day loan, that means by the end of the year, you will have paid 521% more than that $500. So unless you're paying that off in 2 weeks, that $500, you're going to be spending an astronomical amount of money. I'm going to try to do some math here. $500 times 21%. According to my calculator, that's $2,605 in interest plus your initial $500. So that's over $3,100 that you would have paid back. So a lot of money. And I think my math is wrong because it's compounded interest over 14 days. So, okay. It seems, I was kind of right there. Okay. It seems like a large number, but that's the reality. Now, Nebraska payday lenders really are allowed to charge up to 459% annually for their loans. So if you're unable to pay them back within the agreed upon period, your total charge will be rolled over into a new charge. So if you originally borrowed $500, you could be charged up to $2,795 in a year for that loan. So as you can see, for folks that are just borrowing 500 that can't pay it back, they're going to end up paying back over $3,200. Oh, wait. Sorry, it's 2,200 in interest, and then the 2,795 is the total for the year. So it's a huge amount of money. So it's predatory strategies for payday lenders. So really they target neighborhoods that reflect their target audience, which is folks that don't have a whole lot. So they start shops in low income areas where there's high unemployment rates, high minority rates. People are there's statistics out there to show the neighborhoods that a lot of people are unable to qualify for traditional loans. They can't just go to the bank, maybe because of their credit scores, things like that. There's lower bad credit or no savings. So they do a lot of research on where they're going to open up a shop to make sure that they're in a neighborhood that is going to utilize them. So here is, as of, I believe this was the end of 2020. This is where our payday lenders were in Lincoln. So the line in the middle of the map there is O Street. There's 10 locations on or near O Street, one south of Highway 2. So as you can see, Highway 2 is the line that goes kind of diagonal through the bottom half. So there's only one Paycheck advance place, and it's down by South Point. They might have taken it out. I know there's one on 27th and O Street that was taken out, so it's not reflecting on this map. But as you can see, on O Street and above is where most of the payday lenders are here in Lincoln. Most payday lenders are aggressive when it comes to getting their money, meaning they'll likely try to contact you regularly and take legal action if the loan is not paid in time. They might let those interest rates accrue because they're going to earn more interest dollars off of you if you don't pay it back before they do legal action, but they will take you to court to get your money. And it is a contract that you're signing, so you are required to pay it back. But you might get harassed by phone calls. I don't know if there's limits to how much they can do, like collection agencies do. They do have legal limits, but they are quite aggressive when trying to get their money back. So what do you do if you have a payday loan? Here are some suggestions. Try to pay it back as soon as you can. Even if you're just paying a little bit at a time, get that paid off as fast as you can and commit to never using a payday loan again. You are absolutely being charged way more in interest than you should. Ask to set up a payment plan with the lender. Take on more hours at work. So if you can, for a short period of time, take on more hours. Try to get that loan paid off as fast as you can. Some suggestions we had was sell some unneeded personal items online and apply that to your loan. Personal loans through banks are rare anymore, but if you can, get a loan to pay off that payday lender. Personal loans at banks, any loan is going to be cheaper than the payday loan and how much they are aggressively charging you through your interest rates. Work with a financial coach to readjust your budget so you can get the loan paid off. That's someone like me as a financial coach to rearrange your budget, see where we can lower your spending for a little while so that you can get that payday loan paid off. And then contact a debt consolidation company to also help. So there's some really great debt consolidation companies. My sister went through one actually several years ago. They're kind of a last resort when you've tried to do everything else, but oftentimes they can consolidate loans and get things paid off faster because they'll negotiate for you. So they're not all bad. Just go to a reputable one. Do some digging online to make sure that they're reputable. How to avoid payday loans? Create a budget. That is first and foremost the biggest thing. Create a budget. Work off of a budget because then you know where your money's coming from and where it's going. And you can make adjustments as needed if you do need some extra cash. And creating a budget opens up the doors for you to save a little bit more because now you know where your money's going and you can cut back on things if you need to. Seek community resources to help with your budgeting. So if you have a healthy budget, Seek community resource to maybe go to some food banks to lower your grocery bill. I like to tell people you shouldn't have to pay for food or clothing in the city of Lincoln because there's somewhere that will give it to you for free. So if there's resources out there that can help you supplement the expense in your budget, take advantage of it. If you need utility assistance or rental assistance, there's options out there, especially right now, that is offering that. So you could take a break with paying that out of your own pocket and focus on getting that payday loan paid off. The My L&K app is really great for assistance. Everything's in there, everywhere that you could possibly get a resource is listed in there by category. And then the kind of the obvious, the seek the higher paying job. Right now, jobs are plentiful. You can get a great job almost anywhere in the city of Lincoln. I saw a sign the other day at Walmart that they were paying $16 an hour. There's options out there. There's a lot of places are willing to work with busy schedules just because they're so desperate for employees. We'll get a second job, even if it's temporary, just to get that payday loan paid off. Sometimes we have to work a little harder for a temporary amount of time to get our finances in order. And that's okay. It's okay to work hard to get our finances in order so that we can not work as hard later because we have a handle on our finances. And then start saving, be proactive. Even if you don't have a payday loan, but you don't have any savings, this is the time to start so that we can avoid payday loans. That's what we're trying to do. So if we have a little bit of some savings, maybe that can help. Savings to pay off some debt later to raise our credit score will help because then we're eligible for loans, things like that, and start building your credit. So paying things off, like I said, build your credit, get things out of collections to set your credit up good so you can get a loan later. There's a lot of resources out there. I would encourage you to YouTube payday loan stories. Just for the reality of what people have been through, it is sad. It's really sad, some people's journey with payday loans, the harassment that they've endured, the amount of money they've had to pay back, years and years and years of trying to pay this back. So it was really eye-opening to watch some YouTube stories about it. So I would just encourage one to do so. But if you have any questions, feel free to reach out. My number and my email are right there. I'm happy to answer any questions right